Hey everyone, my name is Ian. I am a dividend stock investor with over 20 years of stock market experience. I like to primarily invest in companies that all of us have heard of before. I invest in a sector of companies called CPG, Consumer Packaged Goods. For example, I own a company called General Mills. General Mills owns this product called Annie's Mac and Cheese. Annie's makes a whole variety of products. One of my favorites is this mac and cheese, and this is a tangible product that is so easy to understand. In the video today, I want to analyze several of my consumer packaged goods holdings in the food sector, that is. I'm going to go over General Mills, the makers of this Annie's Mac and Cheese. I want to go over Campbell's Soup Company as well. You may not know, but Campbell's Soup Company pays a nice dividend, and they also manufacture goldfish. So many of us love to snack on goldfish, especially my family. That's why we buy them in bulk now from Costco. And so I'm going to cover the Campbell's Soup Company in the video today as well. I want to cover one of my favorite stocks of all time, one that is my number 2 favorite stock of all time, and that is PepsiCo. And you may not know that PepsiCo, in addition to making sodas, they make other beverages like the Izzy brand of beverages. But also PepsiCo makes some snack foods as well. And so they produce the Frito-Lay brand of potato chips and snacks. Also, PepsiCo owns Quaker Oats as well, which makes Quaker Oats, obviously, and along with that acquisition came Gatorade and also Tropicana orange juice as well. But perhaps most excitingly today, I'm going to cover a brand new dividend stock, one that is a sweet dividend stock, if you will. Halloween is over, unfortunately for my kids, because they love that holiday so much and it always seems to come and go so quickly each year. We didn't get a lot of trick-or-treaters this year with the pandemic. We left some candy out front. It honestly seemed like only about 3 pieces of candy left the bowl because I counted. But what we had this year were these Kit Kat bars, as you see here. Here's what the bag looks like. We still have some of them left, although we have been snacking on these Kit Kat bars. And anyways, Kit Kat, believe it or not, is a brand that is owned by the Hershey Company. And so I'm going to cover the Hershey Company in great detail in today's video. And I am not as familiar with the Hershey Company. It's a new dividend stock that I have not analyzed before, but I'm very familiar with the other stocks I just mentioned. And so I'm going to show a matrix of all of these stocks, and I'm going to compare them all. I'm going to see the pros and the cons of the different stocks from a dividend investing standpoint. Now, my dividend investing strategy is not a get-rich-quick scheme. It is not a get-rich-quick overnight scheme. But over long periods of time, dividend stocks like the Hershey Company, for example, have performed very well. As you can see on the screen right now, the Hershey Company has outperformed the S&P 500 over long periods of time. And many of the stocks that I own in my portfolio, consumer packaged goods companies, have tended to do really well, just like the Hershey Company, because these are valuable products that all of us need to eat to literally survive. And now that we're all spending more time at home, there's a renewed focus amongst this sector with consumers and investors alike. So I have a huge analysis to share with all of you today. If you want to download that analysis for free, it's really easy. All you have to do is just smash that like button for the YouTube algorithm, and then please check in the description below, in the pinned comment below. I'll have a link where you can go ahead and download the Excel spreadsheet that I'm going to cover today, and then you can follow along at home for today's video. Get ready, everyone. It's going to be another fabulous dividend investing video. All right, everyone. So I want to start out just with a brief overview of the Hershey Company. So check it out on the screen right now. These are a few facts about the company. Now, believe it or not, this company is obviously a sweet dividend stock because they make sweets, but honestly, the performance of this company speaks for itself as well, and the performance is really sweet as well. This company has been in business for over 120 years, and it includes over 80 brands, including Hershey's, Reese's, Hershey's Kisses, Jolly Rancher, Icebreakers, and one of the things that I wanted to say is Disney recently suspended their dividend. And as you know, I invest in dividends, but I also invest in dividends for my young children on their behalf so that their financial future can be really bright. And also I can start educating them along the way on the benefits of saving money and reading tons of annual reports like I do and investing in dividend stocks. But anyways, with the Disney dividend suspension, I've been thinking, hey, for the kids in their portfolios, should I be thinking about another stock other than Disney that would resonate with kids? And so I had not looked at Hershey, honestly, at this level of detail ever, but it kind of piqued my interest because I know with Halloween here, or Halloween just passing, and my kids loving that time of year, loving Halloween, what is something that goes hand in hand with Halloween? It is Hershey's. And so I thought this would be a really interesting stock for adults, obviously, but for kids as well. So check it out on the screen right now. I want to share with you my Excel spreadsheet. And again, you can download that from the description in the pinned comment below. All you have to do is hit that thumbs up button, that like button, and then show some love and appreciation for the channel. And then you'll be able to download it for free. And let's go through this thing. It's a beast of an analysis. And so as you can see on the screen, I am comparing Hershey, Campbell's Soup, General Mills, and PepsiCo. And I own so many consumer packaged goods stocks. I could have included more, but I felt like these were good comps. I think Campbell's Soup, General Mills are the two closest comps that I own because they're similar in size to the Hershey Company, and they're similar in focus to the Hershey Company, somewhat at least. Pepsi is a little bit different. It is a much larger company with a much larger market cap. It is more focused in the beverage industry. That being said, I wanted a larger cap comp to get a flavor of what that looked like. And before I dig into this analysis a little bit further, one thing I just want to point out is with the pandemic, we are all at home more frequently. And I think even when this pandemic passes, consumers are going to stock up and probably enjoy eating at home more. And so I think that bodes well for all four stocks. And Hershey's in particular, I almost look at it a little bit as a sin stock because what they're selling is sweets. And, you know, we don't want to overindulge in sweets, but surely enjoying them in moderation is something I do. I love chocolate. I so love it. And, anyways, I thought that was just a unique way to look at it, is that something like Hershey's, whether you're in a good economy or a bad economy, consumers want those simple pleasures, and indulging in some chocolates is such a simple pleasure that adds value and a little bit of joy and excitement in the day of the consumer. So check it out on the screen right now. And what you see here is just, let's look at the market cap. So Hershey's is $32 billion. Campbell's $15 billion, General Mills $37 billion, PepsiCo $201 billion. And so I really think Hershey's, General Mills, Campbell's are kind of a good comp, especially Hershey's and General Mills because they're very close in size. And I looked at the analyst estimates for this year and next year. Now, this year depends, what they call the year depends on which company it is, because some of these companies are on a fiscal year, others are on a calendar year. Anyways, I look at either 2020 or fiscal 2021. Some of these companies are on the calendar, some are on the fiscal 2021 year. And the forward PEs on these stocks are very interesting. What you see for 2020 for Hershey Company is it's trading at a forward PE of nearly 25. And next year, it's trading at a forward PE of 23.68. Richly valued, fairly valued, not on deep discount. Campbell Soup is trading at a current year forward PE of 17 and a next year forward PE of 16. I highlight this. I always highlight the cells in the analysis that are most interesting to me, the ones that where I really kind of took a nugget of wisdom from them. And so one of the first nuggets of wisdom I took out of this is, wow, I don't look at Campbell Soup that much because it's not a core top tier stock in my portfolio, but maybe I ought to be. It is trading at a discount right now when I look at it on a PE ratio basis. Moving on, General Mills also even better than Campbell Soup, or comparable at least. This year better, next year a little worse. This year it's trading at a forward PE of 16.86. Next year at a forward PE of 16.59. And so I highlight that because General Mills, one of my takeaways, I'll just forecast it here. And I'm going to do a slide at the end of this video with all of my takeaways from the video. But one of them is overall, sometimes I look at a new stock and I compare it to stocks I already own, and it tells me something about the stocks I already own. Hershey's, by comparing it to these other stocks, kind of illuminated for me, wow, Ian, General Mills is one of the best overall values right now out there, most likely. In all of this 46 stocks you own, it's an interesting value, and you don't look at it every day, but don't forget about it. And so that was one of my takeaways. Let's keep moving. PepsiCo is trading at a forward PE this year of 26, next year 24. Really expensive. These days, I'm adding to it sometimes, but I'm only adding it to it because I love it. It's my number 2 favorite position, but it's expensive, just like Hershey. Most expensive of the bunch, but maybe that's because it has the biggest competitive moat of the bunch, being a $201 billion company. Moving on to the next section in this analysis, I want to go into the dividend a little bit, the dividends of these companies. And so the dividend yield on Hershey is 2%. Starting yield is not very high, 2.07. Campbell's 2.81. Not bad, but anything under 3% these days is it's a little low for me. Why is that? I'm at the point in my dividend investing career where I'm already using some of my dividends to pay bills. As time goes on, I want to use more of my dividends to pay bills. I want to get to my early financial freedom, which is a fat financial freedom, if you will, meaning I'm not looking to scrape by frugally when I retire. I want to live a life of luxury, if you will, on dividends. And so I'm not putting down, obviously, those who are going for a more lean fire. Everyone needs to find the goals for themselves. I'm just sharing my goals here. But anyways, as I get closer and closer to that goal of fire, I need current yield and I need yield now. And so I have less years left, if you will. And so getting stocks with a starting yield of at least 3%, it's kind of in my mind these days. Less than 3%, it's a little low. And so anyways, keep moving. General Mills, I highlight it. Starting yield 3.33%, right in my sweet spot for where I am at in my own journey. PepsiCo 2.81, same starting yield as Campbell's. And so of the bunch, Hershey's has the lowest starting yield. That being said, let's go on now to the 5-year compound annual growth rate. When I compare the current dividend per quarter versus the comparable dividend per quarter in 2015, what's the growth been annualized for these 4 companies? Hershey, I highlight, very healthy, 6.64%. I like a 5-year compound annual growth rate of about 7%. That's kind of always been my sweet spot. And you see it right here on the screen with 2 of the companies, with Hershey and PepsiCo. You get Hershey at 6.64, Pepsi at 7.8. With Campbell's and General Mills, slow going. Although I'll tell you, General Mills might pick up because they're digesting that Blue Buffalo acquisition, and I think they're digesting it quicker than they thought. Campbell's, it might pick up, although I won't hold my breath there because Campbell's isn't really the kind of company that raises its dividend like clockwork. It's usually the type of company that raises the dividend kind of haphazardly over time. But anyways, Campbell's had a number of management issues. They made a number of bad acquisitions over the years, but then they made this Snyder's Lance acquisition. They make the pretzels and snack foods, which worked out really well. They got rid of a bunch of their bad acquisitions. And to me, it seems like Campbell's is back on track right now. And so anyways, both General Mills and Campbell's dividend growth actually might be in the future better than it looks. And with Pepsi, it's probably not as good as it looks because the payout ratio is high. With Hershey's, it's probably going to continue to pace as it has been. And so let's continue. What we want to look at next is just payout ratios. I already hinted at this a bit, but the payout ratio at Hershey's this year is 51.7%. Next year, 49.1%. Healthy payout ratio, a lot of room to increase the dividend. Campbell's, best of the bunch. And this is what I'm saying. There's opportunity to increase the dividend. They might not do it this year. They might not do it next year. It's more haphazard. But when they do it, there's room to do it with a forward next year payout ratio of 46%. General Mills, not bad either. 56 this year, 55 next year. Reasonable payout ratios. PepsiCo, I probably should highlight this in red. But whenever I highlight it in red, it's hard to see. But the payout ratio is not very good. And so this is something against PepsiCo. They've raised the dividend so quickly over the years, but they've done it quicker than they're scaling their earnings. And so the problem with that is at a certain point, there's not much left. There's just not much left. And so certainly, I think at this point, given how high their payout ratio is, PepsiCo is probably only going to grow the dividend as fast as they can grow the earnings. And it's probably not going to be at the same clip at which they've been doing it. And so that's a red flag potentially with PepsiCo. Now, let me tell you, why am I hating on PepsiCo here? I, as an investor, always need to kind of criticize and critique what I'm doing. I've kind of made this de facto statement that PepsiCo is my number 2 favorite stock of all time. And it will be my number 2 favorite stock of all time, most likely into the future. But at the same time, I have to be critical of myself. Ian, why is it number 2? Ian, should it still be number 2? Ian, are you focusing your net new capital on the right things? Because I'll tell you, I'm adding money to Pepsi now. And am I doing that at the expense of better opportunities? Maybe a net new position in Hershey or adding more to my General Mills or Campbell's. Quite frankly, when I look at this analysis, again, one of my takeaways is General Mills kind of ticks a lot of boxes off of the checklist here. There's probably better values than PepsiCo right now. And so again, I got to be critical because that's how I can be the best investor possible. And that's just a life lesson as well. You kind of get older in life and you start just being more critical and more open to feedback, and that's how you learn quicker and you improve quicker. Let's keep going. And so moving on, I want to talk about the income statements for these companies. And so the next part of it, let's look at the revenue. I look at the revenue. This data was pulled from annual reports. And so to prepare for this video, I spent a lot of time digging through annual reports. And so again, the annual report was either the 2019 calendar annual report, or it was the fiscal 2020 annual report. And so I look at revenue for all of these, and so you can see Hershey is about $8 billion a year revenue, Campbell's 8.6, General Mills 17.6, Pepsi, it's a beast, $67 billion. I also pulled the revenue from 2017 calendar year or fiscal 2018. This was just a 2-year comparison, but you can see over a 2-year period, Hershey has grown their, and this is pre-pandemic, by the way. This was, again, mostly pre-pandemic. Some of the fiscal might have got into it, but it's basically pre-pandemic data. Last 2 years, Hershey was up 6.3% in revenue. Campbell's 31.4%, and I highlighted, although I have to be careful because some of that was likely caused by the acquisition of Snyder-Lance, so it's not necessarily an organic revenue growth. General Mills, 12%. Again, some of that's probably boosted by the Blue Buffalo acquisition, so it's probably should have highlighted it like Campbell's. Pepsi, 5.7%. And so you see a tail here of 2 companies that are kind of slower, steadier growth on the top line sales. And you see 2 companies that are hyper fueled with growth. But again, that hyper fuel, it may be just because of the acquisitions they're making. So moving on, What I want to look at next is gross profit and gross margin. Gross profit, gross margin is basically the profit after the cost of goods sold. What I want to show you here is Hershey kind of falls into a similar bucket as Pepsi. The types of products that they manufacture and sell are not expensive. So apparently, I don't know about the Annie's mac and cheese, but I'm saying the portfolio of products that are sold by General Mills, the types of products that are sold by General Mills like this, they cost more to make this, more to manufacture this than to manufacture this, the Kit Kat bar. I'm just saying in general. And so when you look at these companies, the gross margins at Hershey are very, very strong. And that's something that's nice because when a company has a high gross margin, it gives it a competitive moat. Obviously, if it's cheaper to make a product and you can sell it for a high price and earn a very high margin on it, that shows you that you just have a fabulous brand. It shows that you have a competitive moat. It shows that you have a really sweet business, if you will. That's one of the reasons I love Pepsi so much. As you see on the screen right now, if you look at Pepsi, they have the best gross margin of all of these. And why is Pepsi my number 2 favorite stock of all time? Their gross margin is greater than 50%. It's 55%. That's a huge deal. It's a huge deal that the products Pepsi makes are basically really cheap to manufacture. So moving on, let's look at operating profit and operating margin. So operating profit, by the way, I'm pulling all this information here off the income statement. The information I shared above, the dividends and the price per share, all that market cap stuff, I basically pull that from Yahoo Finance. But the stuff I'm talking about now, I pull from the annual reports and I pull this information from the income statement. And so I'll show you later that I have some data I pulled for the analysis today from the balance sheet and also from the statement of cash flows. But right now we're on the income statement. So check it out. I want to talk about operating profit now. And what operating profit is it's further down on the income statement. In addition to subtracting out the cost of goods sold, you subtract out other stuff such as sales, general, administrative, marketing, expenses, all of that kind of stuff. Now, operating profit is the profit before the company is paying taxes. It's the profit before the company is paying interest, if you will, on debt that they have. It's the operating profit. It's a really key metric that I like to look at in addition to the gross profit. So check it out. And with operating profit, what is so interesting is that the Hershey Company, the operating margin I highlight, it's the best of the bunch. These guys have a robust 20% operating margin. That is just fabulous. That is a really strong margin. Campbell's is at 12.7%. It's the lowest of the bunch. The stock probably should be selling at a lower PE because of this. Typically, companies that are better companies have better metrics. They warrant a higher PE. Maybe one of the reasons Campbell's is on discount is their operating margins. They are the lowest of the bunch. Now, with General Mills, they have a respectable operating margin of 16.8%. Second best of the bunch. And this is what I'm saying again. Is General Mills honestly kind of this sleeper stock that no one talks about, that I don't even have on my kind of core ride or die list, if you will? But I'm ignoring it, but I shouldn't be ignoring it. This is what's so fun about analyzing these stocks, because insights come out of it. Not even about Hershey, about other stuff. Now, check it out with PepsiCo. Their operating margin is a respectable 15.3%. But let's just look at this really quickly. Let's just look at this. This company is at a 55% gross margin, and then it just plummets. Absolutely plummets, gets crushed, gets destroyed with operating expenses, down to a 15% margin. This is something with Pepsi that kind of I must have forgotten about. I didn't remember about, and that's why I do these analyses, is maybe that's not that good, but on the plus side of things, I would say, man, Pepsi, if you're watching, there's room to streamline your operating expenses. Are you paying what are you paying for? I guess that's the way I would put it. Can you use disruptive technology? Can you use new technology, new systems, big data? Can you do something to streamline your operations, because your operations are too expensive, Pepsi? I'm just telling you, room for improvement. But the good thing is it's always easier to improve an operating margin, in my opinion, than the gross margin, because the cost of making the goods is the cost of making the goods. And for example, if they want to, let's say Hershey, for example, wanted to have a better gross margin than they do. Well, when they make these bars, they would have to start skimping. And when you start skimping, you're going to make an inferior Kit Kat bar. And so when you make an inferior Kit Kat bar, no one likes the taste for Kit Kat anymore. This is actually a concept I want to share. There's an author, her name is Pippa Malmgren. She wrote a book, and I forget the name of the book. I think the name of the book is escaping me for now, but one of the concepts in her book was shrinkflation. And basically, if you see companies with rapidly increasing gross margin, what they're doing is shrinkflation. They're basically making their products inferior as to what they were a few years ago to try and improve margins. But the problem with that is the consumer is discerning. I'm not going to keep eating Kit Kat bars if the quality of the Kit Kat bar goes down. And so anyways, I don't like to see gross margins expanding too much at a company like this, a CPG food company. But operating margins, come on, Pepsi, there's got to be room to do that. So let's keep going. I want to look at net margins now. Net margins are the margins at the bottom of the income statement, bottom line. What are these companies making after all of the expenses, including the taxes and debt payments, all that good stuff? Net margins at Hershey are 14.4. Net margin at Campbell's goes up from 12 to 18. I think I highlight that, but honestly, I probably shouldn't. I highlight it more because it's an outlier, but be careful with that. It's an anomaly, if you will. I think there was some one-time tax stuff going on at Campbell's. Operating margin's not that good there. Operating margin at General Mills was a 12.4. Respectable. Pepsi, 10.9. Again, of the bunch. And man, does this... It just kind of checks my ego a bit. My number 2 favorite stock of all time is the worst operating margin, or not even operating margin, net margin of the bunch. 10%. On operating margins, the worst was Campbell's Soup, with Pepsi as the number 2 lowest. On net margins, it gets even worse. Pepsi had the worst. Although, quite frankly, I don't know what the real net margin is of Campbell's here. This 18% is an outlier. It's an anomaly. But what I would say here is the best net margin, if I factor out Campbell's, is actually Hershey. And so, again, it seems like Hershey has a business model that produces a really sweet product, and this product is lucrative from a margin standpoint. And it's always good to have strong margins because it gives a company defensibility. It gives a company options. And so I want to move on now, but before I do, please a reminder to hit that like button. Do you guys buy stuff in bulk like this, like we do at Costco? Do you save money doing that? Give a big thumbs up if you do. Comment in the description below. Man, these goldfish are good. And I'll tell you a hack. I'm a runner. I'm a long distance runner, and my foot is healed. I'm at it again. And I'll tell you, this is a weird hack, if you will, but when you buy the Pepperidge Farm products, the goldfish in those little bags, kind of that classical bag they have at the supermarket, there's less salt in it. If you buy the big old box at Costco, it's got more salt. I kind of like the salt because it helps me with my running when I'm rehydrating. And so, fun hack for all the runners out there. Anyways, let's move on. Check it out on the screen. Balance sheet time. And so, I'm going to go quick here. I just take a quick top level view at assets, liabilities, and shareholders' equity, also known as book value. And I'm going to go pretty quickly here. But what you see is that the Hershey Company does not have a lot of equity. Campbell's, it's some equity. General Mills is totally crushing it on equity. And PepsiCo, as you would expect for a company that is as big as they are, they've got the most equity. But my takeaway from this, and what I highlight, and this surprises me because General Mills just made a huge acquisition. They took on a lot of debt. They bought this Blue Buffalo company. But despite doing that, and I think the pandemic kind of, but this actually I even pulled pre-pandemic. And so can't factor even that in. But what I was going to say is the pandemic is boosting their business, as it is with all of these guys. I'd say Pepsi and Hershey, maybe not quite as much, but you'll see in a minute. I'm going to go through some quarterly results as well. They're all getting some boost. But what I'm saying is that equity seems disproportionately strong at General Mills from their 2019 annual report, the last annual report that they released. And so I was just surprised to see that. I was surprised to see so much equity given the scale of the company. Again, I'll probably go out and buy a tranche of General Mills. I'm not even reinvesting my dividends in this thing. I feel guilty. I'm sorry, General Mills. I probably ought to be reinvesting my dividends into you, and I'm not. So I just want to take a quick look at the statement of cash flows, and what I look at is just the net cash provided by operating activities. I don't want to spend too much time here, but one of my takeaways, obviously, you'd expect Pepsi being the biggest. You'd kind of expect Campbell's being the smallest. But what I was excited to see, again, is just General Mills. It's a little stronger than I thought it would be, especially as compared to Hershey's. It's got some strong cash flow going. And then what I also like to look at on the statement of cash flows is the net cash increase, decrease. And to be fair, this can be volatile. It can go up and down because certain companies may have a big year of financing activity or they have a big year of investment activity. And so this can be a volatile number, but I was surprised PepsiCo let it swing this negative. And in fact, I want to look at that in a minute. I was surprised PepsiCo let it swing this negative. And General Mills, I was pleasantly surprised that it was running so positive. And so I'll share more conclusions out of all of this in a minute. But before I do that, check it out on the screen right now. I want to go through very quickly here and look really quickly at the PepsiCo statement of cash flows. And so this is the statement of cash flows from their last annual report. And you can see here the net cash provided by operating activities is at $9.6 billion. It was the biggest of the bunch, as I would expect. Worth noting, it's actually down from 2017. And so this company hasn't really been growing cash flow for the last few years. And so that's something worth noting. Again, I got to be critical. I got to be critical of my own stocks. You can see here net cash used for provided by investing activities. This company really swung negative here in 2019. And I start looking into, well, what happened? Well, one, they had a huge amount of capital expenditures. And so that's something that I have to keep my eye on. What is Pepsi investing here in CapEx? Are these new warehouses? Is this new technology? What is it? We got to keep an eye on that because it's quite high. Acquisition of SodaStream, hey, that's all good. That was acquisition related, but that swings a big negative number. But again, I got to be careful because these numbers, they can go back and forth each year. And because you can see right there in 2018, they had a large positive on the investing activities because it looks like they had some short-term investments reaching maturity, a large amount. And they had maturities, but they didn't have as many purchases. And so there's games that get played on this stuff year to year. And that's sometimes why it's better just to look at the top line net cash provided by operating activities. That said, I do like to dig into the numbers because I see stuff. And my biggest takeaway so far as I go down this is the CapEx is awfully expensive and it's getting bigger and bigger at Pepsi. What are they doing? Moving down to financing activities, check this out. Dividends are getting bigger. Repurchases are getting bigger. They went from $2 billion in the last in 17 and 18 up to $3 billion in 19. And so then you look 2019, you look kind of at the bottom, not the bottom line, but the one a few up from it, the net decrease, increase in cash and cash equivalents. And you see, I just like to see a positive number here each year. I think it's good management to see a positive number each year. And so in 17, it was a positive 1.4 billion, 18 positive 112 million, minus 5.199 billion in 2019. I don't like that. I want to see what happens with Pepsi over the next few years and get a better handle if this was a one-time anomaly or not. And so this is just something, again, that is in contrast to what I saw with General Mills in their most recent year, and it gives me a pause. It makes me think my next tranche of money for this type of stock, should it go into Pepsi or should it go perhaps into General Mills? And so with all of that, I want to share now some quarterly reports. Next segment of the video, I want to do this really quickly. I'm actually just going to share the top line. I'm just trying to tell a story here actually through press releases. So check it out on the screen right now. First one is the Hershey Company. What you see from Hershey Company, this was released on recently, just on November 6th. And it says that sales are up 4%. Organic constant currency sales are up 3.8%. And net income increased 39%, but adjusted net income increased 15.5%. So the story here with Hershey is during this pandemic, they are doing just fine. Consumers are looking for those simple pleasures, and I can totally see why Hershey would be a great company that investors would want to own. I can see with the high gross margins and with kind of the recession-proof business model, if you will, everyone needs chocolate once in a while, that they would do well. Moving on, I want to look next at the Campbell's Soup earnings release, the most recent one, so you'll see it on the screen right now. And what you see with Campbell's Soup in their most recent quarter, this is the one, this earnings release came out on September 3rd. And net sales increased 18%, organic 12%, increased demand for their products. Adjusted EPS increased 50%. Wait, am I reading that right? Fourth quarter earnings per share. Adjusted, 50%. And it says net sales and organic net sales increased 7%. All right, for the full year. That's the full fiscal year. So on and so forth. Again, Campbell Soup seems to be doing really well right now. A lot of these consumer packaged goods stocks are doing really well. And again, one of the things, I say this so many times, but I have to keep repeating myself. So many people think they have to invest in tech stocks for growth. And look, this is get rich slowly with companies like this, with products like this. But these types of companies that I invest in tend to be less volatile. These types of companies allow me to sleep well at night. These types of companies I can easily understand. These types of companies do well in any economy. They're not related on business-to-business purchases. They're related on consumers like you and me that need to eat. And so moving on, let's look at General Mills next. And so I want to take a quick look at the General Mills most recent quarter. This release came out on September 23rd. Net sales increased 9%. Organic were up 10%. Operating profit up 29%. Constant currency adjusted was up 22%. EPS were up 21%. Adjusted 27%. And they increased the dividend. Oh my goodness, I'm telling you, I am so pleased as a General Mills shareholder. I regret not reinvesting dividends here for a while and not adding more money. But look, it's not too late. It's still on sale. And I will tell you this. So many people a few years ago, when I announced here on YouTube, hey, I'm adding a new stock to my portfolio. Hey, I'm going to invest in General Mills. People didn't get it at the time. They thought this was an old world company on its way out. They thought that the Blue Buffalo acquisition was kind of a Hail Mary, kind of trying to save this company from doom and gloom. Fast forward a few years, look how well they're doing, and look how quickly they're paying down that acquisition of Blue Buffalo. Love it. Let's look at Pepsi really quickly. Check it out on the screen right now. I want to look at the last quarterly report from Pepsi. This one was announced on October 1st. That's when the report came out. I like to look at the organic non-GAAP, so I'm just going to go to the second table. And the organic was up 4.2% on revenue. The EPS was up 9%. And so, hey, Pepsi, that's what I want to see, 9%. And so Looking good, Pepsi. I hated on you in this video too much. I'm sorry, my old friend, but I have to be critical. But that's what's up with Pepsi. I want to close out today. Before I do, please hit that like button. Show me some love here. That's how we help my videos reach more people out there. These free videos, my best work that I share here on YouTube for free. That's how that happens. So please help out your friends. Help out everyone in the Dividend community by helping these videos reach as many people as possible. It means the world to me. Check it out on the screen. Let's close out today with some conclusions. And so I would say all of these are great companies that meet a distinct need, market need during 2020. They're the unsung heroes of 2020, in my opinion. They're keeping us nourished and safe. Hershey has a very strong dividend compound annual growth rate with a low payout ratio. They have great margins all around, expensive PE, and it's not the healthiest product, but I have a sense that there will always be a demand for this type of product. It may even be considered a sin stock. And so am I going to buy Hershey here? Probably not for myself right here because it's quite expensive. And I have enough exposure. I have enough stocks. Will I buy it for my kids? Maybe. I might do that. And so we'll see this holiday season coming up, this Christmas holiday. I like to buy the gift of stock. And so as I do, will I be buying Disney or will I be adding something new to their portfolio like Hershey? I think Hershey is the type of company that they could get totally excited about. Let's keep moving. Campbell Soup, fabulous starting PE, best payout ratio of the bunch. It has a strong net margin, but I think it's an anomaly. Great growth with that Snyder's Lands. I'll tell you something. I probably ought to show Campbell Soup a little love here and buy some more. I think they finally figured stuff out. I think they finally got their management team figured out. I think they finally got their acquisition portfolio figured out. I think they're hitting their stride, so to speak. I like what you're doing, Campbell's. Let's keep moving. General Mills, best overall value, fabulous PE ratio, fabulous starting dividend yield, best balance sheet of the bunch despite this Blue Buffalo acquisition, strong statement of cash flows. Hands down, there would be no reason, in my opinion, as a dividend investor not to buy General Mills here. I really like it. I will be buying more. Moving on, PepsiCo's largest market cap, strongest dividend compound annual growth rate, but is it sustainable with that payout ratio? I don't know. Best gross margins, but man, do they get hit hard on that operating margin. I never really focused on it till now. And they have that horrible statement of cash flows for the last annual report that I need to keep an eye on. But Pepsi, I got nothing but love for you. All right, everyone. Before I leave today, in terms of full disclosure, I am long Campbell Soup, ticker symbol CPB. I am long PepsiCo, ticker symbol PEP. I am long General Mills, ticker symbol GIS. And my kids are long Disney, ticker symbol DIS. Before I leave today, in terms of a friendly disclaimer, today's video is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. I'm just sharing my personal journey here on YouTube for fun and entertainment. There is immense risk investing in the stock market. You've got to be careful. All right, everyone. I love you all. Thank you for your support here on YouTube and beyond. I'm on Patreon too, and I upload videos on Patreon for my generous patrons each week. They're a little bit shorter and more impromptu. Head on over there if you want even more of me. And those who choose to invest in me on Patreon, that is money well spent because it helps me do more videos on Patreon and it helps me do videos like this here on YouTube. I love you all, and I will see you in the next video.